Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. It was a disappointing Tuesday for the Australian dollar after the recent bullish advance, along with the confirmation of the Dragonfly Doji, was crushed following the reopening of the US market after being absent in observance of US President's Day. Meanwhile, the US dollar index, which measures the greenback strength against a basket of six major currencies, rebounded and captured the 104 handle. On Tuesday, the message from the minutes of the RBA board's meeting in February released was clear that the interest rates are warranted and, surprisingly, a more hawkish board than we saw at the last meeting in December. According to the RBA minutes, policymakers also considered the option of 50 basis points interest rate hiking considering the persistence of inflation. Meanwhile, looking at the data today, Australia's Q4 wage growth was softer than expected, according to the data released by the Australian Bureau of Statistics, the ABS. Wages increased by 0.8% over the December quarter, below the 1% forecasts. In turn, annual wages grew by 3.3%, below the 3.5% expected forecast. Meanwhile, in overseas economic data, the US FOMC minutes will also be released on Wednesday, with expectations that the US Federal Reserve will stick to its hawkish stance in the wake of high inflation. We also get the US gross domestic product, which is the GDP, on Thursday, and also the personal consumption expenditures, or the PCE, due on Friday. This is the Fed's preferred measure of inflation. So looking at the Australian dollar, since the reversal, the market is looking back towards the bottom side. That is around 68 figure 35. A break here would give further exposure down towards 66.5, with any advancement likely to find resistance around 68.70 in the short term. Looking at the euro, the market is focusing back on the bottom side of the range around 106.20. As I mentioned, the dollar index surged to 104 figure. In light of the pattern, if we break 106.20, then this would give further exposure down towards the region of 105, which looks like it's most potentially holding due to the ADX is holding to a bear case and also the technicals are weak. In light of the pattern, dollar yen is still maintained its upward course, and with the ADX supporting a bull case, slightly overbought from the RSI and the MACD bullish, I'm still looking at 136 as a potential target, so there's still around about 120 points left on the upside, with any pullback likely to be shallow. Sterling surprisingly come out firmer in terms of other markets and maintains its upside quest, that is towards the region of 121.35 to 121.75. The following better than expected UK S&P Global, or the CIPS data for February, that is the manufacturing PMI, rose to 49.2 versus 46.8 expected, and from that the services PMI jumped to a 7-month high of 53.3 compared to 48.3. From that, the market's likely to still feel that the Bank of England is still struggling to bring down inflation. However, looking at the assessment, we may see a 25 base point rate hike in March. I feel we're getting a little bit toppy up towards this region around 121.75, so let's see if profit taking emerges. Finishing up with gold, well, the shine has come off the market as it slips further to the downside and looks towards 1,820 as initial target. Be on your guard. A break there would give further scope to the downside and negate the hammer and look towards 1,786 to 89. Unless we see a break of 45, then I feel that the top side target has been reached in terms of a cap around 45, and the risk is still to the downside. Wrapping up with oil, well, we're not seeing any real bounce from this key level, that is around 75.60. A break here would give further exposure to the downside and look towards the region of 72.40.60. Well, that wraps it for today. Thank you very much for joining me, and as always, look out for the intraday report, and I hope you enjoy the rest of the day.